For 3 straight quarters, Warren Buffett has been unloading billions of dollars in stocks, selling, and selling some more. But now, he's flipped the script. Suddenly, he's buying again. Why the change? What caught his attention? And most importantly, should you follow his lead? Markets thrive on two powerful emotions, fear and greed. These forces can push prices to dizzying highs or drag them to crushing lows, and most investors get swept up in the chaos. In this video, I'll show you how Buffett's approach to fear and greed. I will show you what Buffett is buying. Why has he gone from selling everything to suddenly buying again? And most importantly, I'll break it all down for regular people like us. What does it mean for you and your investments? Should you follow his lead, or is this a moment to pause? Let's dive into the heart of the matter. Warren Buffett's massive cash reserve. Berkshire Hathaway is currently sitting on a jaw-dropping $325 billion in cash or cash equivalent. To put that into perspective, this is the highest cash pile in the company's history, and it's not just sitting idle for no reason. Take a look at this chart. It shows how Berkshire's cash position has grown steadily over the years, reaching its current peak. And yes, Buffett has been on a selling spree recently. But let's break it down. Why is Buffett selling when the market seems to be thriving? Well, it all comes down to his philosophy. Buy great businesses at fair prices, not overinflated ones. Right now, the S&P 500's forward PE ratio is near levels last seen during the 1999 dot-com bubble, as shown in this graph. Back then, soaring valuations led to a historic crash, and today's numbers are strikingly similar. For Buffett, these elevated valuations are a clear signal to wait. He prioritizes buying great companies at fair prices, and when valuations climb this high, the risk outweighs the reward. This graph highlights a recurring pattern. Whenever PE ratios reach such peaks, turbulence often follows, making Buffett's cautious approach all the more prudent. In recent years, Berkshire has reduced its stakes in key sectors like financials, technology, and even consumer staples. Buffett is locking in profits at market highs. At the same time, he's avoiding the trap of buying overpriced assets just because the market is surging. And here's where it gets interesting. This selling has resulted in Berkshire holding 30% of its total assets in cash. It shows just how unprecedented this level of cash is in Buffett's portfolio. It's a clear sign of caution in today's overheated market. But there's more to the story. Buffett isn't just sitting on this cash to ride out uncertainty, it's about staying ready. Historically, Buffett has built up reserves like this before market corrections or during periods of high overvaluation. Take 2008, for example. Just before the financial crisis, Berkshire held a significant amount of cash, which allowed Buffett to buy undervalued stocks and companies when the market bottomed out. The same thing happened in 2020 during the pandemic dip. Berkshire deployed billions into high-quality businesses. Buffett's strategy isn't about predicting crashes or timing the market. It's about value. He's waiting for opportunities to buy great companies at prices that make sense. In his view, cash isn't wasted when it's yielding competitive returns. In fact, with today's interest rates, cash is earning more than it has in decades. This makes it a viable alternative to overvalued stocks. But let's clear up a common misconception. Buffett's strategy isn't passive. Holding cash doesn't mean he's sitting back. It means he's positioning himself for action when the market corrects or when high-quality companies become available at reasonable prices. And that's why this $325 billion cash reserve is so significant. But the burning question on everyone's mind is, what could he buy next? To answer that, we need to dive into how Buffett thinks about investments and the factors that might shape his next move. Buffett has always been drawn to companies with what he calls a strong moat. These are businesses that dominate their industries with durable competitive advantages. Companies like Coca-Cola, Apple, or Bank of America. These are household names with reliable cash flows and powerful brand recognition. But here's the thing. Buffett isn't just interested in great companies. He's interested in buying them at the right price. If the numbers don't make sense, he's willing to wait, no matter how popular or successful the company may be. Recently, Buffett has shown that he's not afraid to part ways with these moat companies when he feels their stock prices become overvalued. For example, he sold off a significant portion of Berkshire Hathaway's stake in Bank of America and Wells Fargo, a longtime favorite of his, when he believed its valuation was too high. Similarly, he trimmed his holdings in Apple during periods of market overvaluation, despite the tech giant being a cornerstone of his portfolio. Warren Buffett's recent purchases provide valuable insight into where he sees opportunities in the current market. While the tech and finance sectors may not be catching his eye right now, his latest buys reflect his classic value investing philosophy, buying companies with strong cash flows and solid fundamentals at attractive prices. One of his largest bets is on Occidental Petroleum, a major energy player. Berkshire Hathaway recently added $405 million worth of Occidental shares, bringing its total stake to an impressive 28%. With Occidental's stock trading at a low price-to-earnings PE ratio of about 10, Buffett sees an undervalued opportunity in a company with consistent free cash flow, even in a volatile energy market. Buffett also took a contrarian approach by investing in SiriusXM, a satellite radio company that's faced significant challenges, with its stock down over 60% this year. But the key to Buffett's interest here lies in SiriusXM's ability to generate steady, recurring cash flow from its subscription model. Finally, Buffett has increased his stake in VeriSign, a company specializing in domain name registrations and internet infrastructure. Though not a flashy investment, VeriSign is highly profitable, with a 60% operating margin and impressive free cash flow. It may not be in the limelight, but its solid business model and consistent earnings make it a valuable asset in Buffett's eyes. The common thread in all these investments is their strong cash flow. Occidental, SiriusXM, and VeriSign each provide Berkshire Hathaway with steady income streams, making them attractive buys in Buffett's book. These purchases reflect his long-standing strategy. Find undervalued companies with reliable earnings, buy them at the right price, and let time do the work. Based on these criteria, where could Buffett be looking in today's market? First, energy is a natural fit. Buffett already has a stake in Occidental Petroleum and Chevron, with its solid 3.65% dividend and low PE ratio of around 13, checks all his boxes: reliable cash flow, essential services, and a history of disciplined spending. Next up, healthcare. Companies like Johnson & Johnson are resilient even in tough times. With a reasonable PA of around 15 and consistent free cash flow of $20 billion annually, J&J's diverse portfolio of pharmaceuticals and medical devices would make a strong addition to Berkshire Hathaway. Consumer staples are another likely bet. Brands like Tide, Crest, and Pampers from Procter & Gamble dominate households. People buy them no matter what's happening in the market, making P&G's steady cash flow and 2.45% dividend a Buffett-worthy pick. Lastly, there's telecom. Verizon offers essential communication services. Buffett's next move will focus on what he's always done best, buying quality businesses at the right price. So, should you follow Buffett's lead? First, it's important to understand how Buffett reached this staggering cash position. His strategy of disciplined selling has played a huge role. Over the past few years, he's sold off overvalued stocks in sectors like technology and finance, locking in gains at market highs. Even in sectors he traditionally favors, like banking, he's adjusted his holdings when valuations got too stretched. The key takeaway here: knowing when to sell is just as important as knowing when to buy. With nearly 30% of Berkshire's assets in cash, this isn't about letting money sit idle. It's about flexibility, security, and being ready for the next big move. Now, here's the critical question. Should you, as an everyday investor, also hold 30% of your portfolio in cash? The short answer is probably not. Buffett's strategy works because he operates on a scale most of us can't comprehend. Berkshire Hathaway is built to weather market turbulence in ways that individual investors simply can't. That said, there's still plenty to learn from his approach. For starters, having some cash on hand is never a bad idea. It gives you the flexibility to act when market corrections happen and quality stocks become available at a discount. Without cash reserves, you might miss out on these opportunities. How much cash you should keep depends on your personal financial goals and risk tolerance, but generally, keeping 5 to 10% of your portfolio in cash gives you enough room to capitalize on opportunities while still allowing for long-term growth. One of the most important principles in investing is focusing on quality. It's tempting to jump on the latest trends, but the real value lies in companies with strong fundamentals, those with a proven track record of steady earnings, a competitive edge, and reliable cash flow. If you can't easily explain why a company is a good investment, it might not be the right fit for your portfolio. In today's fast-paced market, it's easy to feel pressured to act quickly, whether it's because of fear of missing out, FOMO, or panic during downturns. But sometimes the best strategy is to wait for the right opportunity. Rather than chasing after the next hot stock, focus on building a watch list of companies you want to own and wait for the price to make sense. The markets are full of predictions and headlines that can easily distract you from your long-term goals. Successful investing isn't about trying to time the market. It's about staying invested over time and sticking to a strategy even through the ups and downs. You don't need billions in cash or to buy stakes in massive corporations to be a successful investor. What you should focus on are his core principles. Prioritize value, practice patience, avoid overpaying, and always stay prepared for opportunities. So, the next time the market shifts, ask yourself, are you ready to act when the opportunity arises? Want to know what Warren Buffett's advice is if the S&P returns 3% over the next 10 years? Click the video on the screen to find out.